Frequently asked questions. Section 453, seller carryback financing in a 1031 exchange. Some taxpayers who sell property held for investment or used in a trade or business may choose to sell the property and incorporate what is known as seller carryback financing as part of the consideration. In that sort of a situation, a taxpayer has a number of options available to him. And what I want to do is briefly go over the options and the alternatives. The first scenario is the taxpayer can try and defer taxes on the down payment received in a 1031 exchange, and then they remain the beneficiary on the note, meaning they're going to receive the payments under Section 453, which means that note is not going to be included in the 1031 exchange. So they're really going to use two different tax code provisions. They'll take the down payment and work with a qualified intermediary, and then have that down payment used and applied towards the acquisition of a replacement property. And then at the same time, the taxpayer, because they will remain the beneficiary on that note, they will receive or be eligible for what is known as installment sale treatment on that note. And what that basically means is, as money is received, taxes are owed. So typically, many notes might be interest only or primarily interest early on. Many have a larger balloon payment down the road. So the taxpayer in scenario number one would not be including the note in the 1031 exchange. They're then eligible for the installment sale treatment on that note. So as payments come in, let's say annual payments, let's just say, for example, it's a 5-year note, interest only with a balloon payment, meaning paying off the remainder of the note balance in year 5. They would then pay taxes as income is received, and then obviously having a larger tax consequence when the balloon payment is paid 5 years down the road. So scenario number one would be a partial 1031 exchange, and the taxpayer remains the beneficiary on the note and gets the installment sale treatment. Scenario number two is one where the taxpayer is going to try to include that note in the 1031 exchange. So just like in scenario number one, the down payment would be going to the qualified intermediary. But the difference in scenario number two is the qualified intermediary actually becomes the beneficiary on that installment note. And there are a number of approaches, a number of ways that a taxpayer can try and include the note in the 1031 exchange. And what I want to do in this is just briefly go over some of those options. There really are 4 possible alternatives to scenario number 2, and I'll briefly highlight these. The first option is if it happens to be a very short-term installment note. So let's say it's an installment note that is less than 180 days. What is the exchange period? So it's a 4, 5, 6-month installment note, something along those lines, but within the 180 days. In that scenario, the qualified intermediary receives the down payment to purchase replacement property. The qualified intermediary is the beneficiary in the note. When the note is paid off in that short-term note within 180 days, they then add those proceeds and purchase a replacement property. So in that scenario, the down payment, and if the note is fully paid off, the proceeds are applied towards a replacement property purchase. The second scenario is one where the taxpayer themselves, or sometimes it might be a relative, a family member of the taxpayer that maybe is looking for the income stream, and typically a little bit of a higher interest rate associated with installment note financing. What they can do is they can actually purchase their own installment note. So the way that would happen is the qualified intermediary is the beneficiary. Somebody comes in, could be the taxpayer, relative they know, they purchase the note, and that's very similar to the scenario we just covered. Then we take the down payment amount plus the payoff of the note, and the qualified intermediary applies both of those amounts to purchase the replacement property. So that's a second way to incorporate seller financing in a 1031 exchange. Now, another approach is to actually assign that installment note over to the seller of the replacement property. So they receive the income stream, and that would be as consideration for the purchase. So here's what would happen. The qualified intermediary has a down payment amount. That is assigned to the seller of the replacement property. And then the seller actually is assigned, the note is assigned to that seller. They then receive the income stream associated with that note. So basically, they're going to be getting an income stream over time, typically secured by the taxpayer's relinquished property. But in certain scenarios, this might work. I would say this works probably best in an area where the seller of the replacement property maybe knows where the relinquished property is in the same general vicinity. It typically seems to work a little bit better where somebody's familiar with the property and property values and they're willing to entertain something along these lines. Now, we've got another scenario out there. Another one that can be done is the note can be sold to people that buy notes. There are across the country many note buyers, and they will buy a note. And when they buy a note like this in particular, they're typically going to buy it at a fairly significant discount. It might be discounted 20, 30, 40% because it's what's considered an unseasoned note, meaning it doesn't have a lot of a payment history on that note. And so there's going to be a little bit of a risk premium built into that, which is in the form of a discount. So in this scenario, the money that is being held by the qualified intermediary, the down payment, and then the funds received from the person who purchases the note are applied to the purchase of a replacement property. So any discount is really treated essentially as an effective reduction in the purchase price of the relinquished property. So I want to briefly touch upon 4 different ways to proceed. Now, let me kind of bring this home. If none of those scenarios work, where the qualified intermediary is the beneficiary on the installment note, so scenario A, B, C, and D do not work, the next thing that can be done is that note can be assigned back to the taxpayer. So the taxpayer receives the note, and then they're still eligible for the installment sale treatment under Section 453. So, to kind of say it more simplistically, if none of the scenarios under option 2, A, B, and C, and D do not work, the note is assigned from the qualified intermediary back to the taxpayer, and they're still eligible for the Section 453 installment sale treatment, meaning they'll pay taxes as they receive payments on that note. So they're really in no worse off position, and they've had the opportunity to potentially explore those other options. Now, it's really important with any seller carryback financing and exchange that the qualified intermediary is notified of this when the exchange is set up, because it's an important question to address up front. Does the taxpayer want to retain the note and receive the Section 453 installment sale treatment, or do they want the option of having the beneficiary be the qualified intermediary in the note and pursuing these other options that are available to them? To review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Please read the full disclaimer, as Asset Preservation cannot provide tax or legal advice. A proper evaluation of the benefits and risks associated with a particular transaction or tax return position often requires advice from a competent tax and or legal advisor familiar with your specific transaction, objectives, and the relevant facts.